In today's video, we're going to look at a few different ways that you can invest your first $1,000. I'll also tell you more about a special report that I put together with the Motley Fool. That report is available for free at fool.com/Arvabelle or in the link in the description. This is the only place that you'll be able to learn more about the top 5 stocks that I'm watching, because I won't be talking about those in any of my videos. So again, that's fool.com/Arvabelle. So once you have $1,000 saved up, if you have no other savings or if you still have debt, there may be a couple of things that you want to do before you actually invest. The first is to put that money towards an emergency fund. So obviously in the last year, we've learned that the unexpected can happen at any point. So if you don't have any other savings, consider if you would rather have that money in a savings account where you could pull from it if you needed to cover your rent for a month, or if there were any other unexpected events. The second thing that you may want to look into before investing is paying off any high interest debt. So as a general ballpark, people will typically suggest that if you have any debt that is at an interest rate of 4% or more, that you may want to consider paying that off. The reason for that is that, for example, if you have a credit card that is charging you a 20 or 25% interest rate, it may be a better use of your money to pay that off, get rid of that debt, get rid of those extra interest payments that are piling up, because if you invest that into the stock market and get, say, 7 or 8%, that isn't necessarily going to benefit you as much as getting rid of that 25% interest rate on a credit card. So it's totally up to you if you want to do either of those two things, but something that everyone should do before actually investing for the first time is determining how much risk you are willing to take. That is going to determine which of the following options in the video you may or may not decide to look into. There are a couple of safer options, and these are things that you may hear your parents or your grandparents or high school teachers talking about, but we'll talk about why these may not be the best option for you. So the first is to put your money into a high yield savings account. Although it is high yield, currently, as of when I'm filming this, interest rates are not that high. So as a general ballpark, you may get somewhere between like 0.4 and 0.6% interest, but at most big banks, like the very big branches that you've heard of, I won't name drop, but most of those will give you an interest rate of 0.01%. 0.01. That is nothing. That means that if you put $1,000 into that account over a period of 10 years, you will end with a whopping $1,001. But if we take into account that inflation is happening over this 10-year period and that your money is actually being devalued at 2%, then that really leaves you with $821.17. So yeah, putting your money into a savings account, you may end up losing money to inflation. Another option that people often talk about is CDs, or certificates of deposit. So these, at times when interest rates are higher, can be an option to look into, but right now CDs are going for anywhere between like 0.4% interest rates to 0.7%. So again, pretty similar to the current rate of savings accounts. And again, this changes all the time, so do check that whenever you are watching this video. But again, pretty similar to savings accounts. And another downside with CDs is that generally your money is going to be locked up for a number of months or years. Now let's assume that you decide that you do want to invest, or you've already taken care of those other things. We're going to divide this into what you should do with $1,000 if that is all you have saved up and you have no extra income coming in, or if you have $1,000 and you have extra income continuing to come in every month. So first, if you have saved $1,000 but you have no extra income coming in, the best place that you can invest that money is going to be in things that are able to generate you a steady income or some steady money coming in on the side. What might that look like? $1,000 is not going to be enough to pay for an entire college education. I wish, that would be great, but it can go a really long way in any of the following. Licenses or certifications, going to trade school or learning a trade skill, buying books, courses, or guides, but do be careful of like the scam scammy guru courses where they just rope you into buying more courses and like spending way more money than you need to. Don't do that. Or it can help go towards a boot camp like for coding or for UI UX design. It may not be enough to cover a full boot camp, but it can definitely cover some of those initial beginner courses or intro courses to help you get started. Or maybe you already have a pretty good idea of what you want to do to be able to generate extra income, and that doesn't require any certifications or courses. So in that case, you could invest that $1,000 into starting a business, and that can go a very long way, especially if that business has low overhead. In other words, low operating costs. It doesn't cost you very much to actually run that business. A few examples: if you wanted to start a YouTube channel, all you really need is a cell phone, which you probably already have, and maybe you can use that money to buy some lights and a microphone. That will maybe run you $100, so you still have a lot of other money to work with. Another option would be if you are starting maybe a graphic design business or a web design business. You can use that money towards any software that you need. Like if you need an Adobe subscription, you could use it towards buying a domain name or buying website hosting. Or if you wanted to start a physical business, you could use that money towards any supplies or packaging that you might need. Maybe you decide to sell online as well, and you can use some of that money towards a Shopify subscription. Those are just a few options, but over time, putting that initial $1,000 into something that's going to continue to generate you income is likely going to be a better investment than just throwing it into a savings account and letting it sit there. Any of these options are what people mean when they say to invest in yourself. Once you have that extra income and you now have $1,000 saved plus extra money coming in, what can you start investing that in? The first option is index funds and ETFs. ETFs and index funds can be a really good option if you are looking for an easy way to diversify and get exposure to a lot of different companies at once. There are a ton of other videos on this channel about index funds and ETFs, and I encourage you to go watch those if you want to learn more. But basically what this comes down to is that index funds and ETFs are like a giant basket of stocks. They have a bunch of different companies in them, and when you buy into an index fund or an ETF, it's like you're getting a tiny little piece of all of these different companies. When you're starting out with that $1,000 or with any smaller amount of money, this can be a great option, and it's sometimes easier than trying to keep track of a bunch of different individual stocks or trying to figure out what fractional shares of stocks that you can buy. Instead, you have a bunch of companies that are all bundled into this one index fund or ETF. Index funds and ETFs are generally considered less risky because if one of those companies in that big basket of stocks does poorly, you have all of the other ones to kind of balance it out. But on the flip side of that, if one of those companies does really, really well, you may not reap the full benefits of that because there's so many other stocks in that basket. So that leads us to individual stocks. Individual stocks are generally considered more risky, but there can also be more potential for growth. So for example, in the past 5 years, SPY, which is one of the world's biggest ETFs that tracks the S&P 500, saw a growth of 103%. I'm sure a lot of you would be more than happy to double your money. But over the same 5-year period, several brands with businesses that are pretty easy to understand actually did much better. So just a few examples: Alphabet, which owns Google, was up 243%. Amazon was up 376%, and Apple was up 460%. So those are returns that are 2 times, 3 times, even 5 times the market. And there are so many different strategies and preferences when it comes to individual stocks, so you really just have to find what works for you. Some people prefer dividend stocks, some people prefer those blue chip stocks, and some people pick stocks from an industry that they know really well. Other people, like myself, enjoy growth stocks that have a lot of upside potential. So if you are ready to go the individual stock route and you want a good place to start, I've partnered with today's sponsor, The Motley Fool, to put together a report of 5 stocks that I think have a lot of potential for growth over the next 5 to 10 years. As you guys know, I don't make videos about stock picks, so this is the only place that you'll be able to get access to this free list along with my reasons for liking them, and it'll be delivered straight to your inbox. You'll also get access to a special offer for new members of the Motley Fool Stock Advisor. Motley Fool Stock Advisor is a subscription-based service where members gain access to their library of expert stock recommendations, which are aimed at multiplying your net worth. Stock Advisor recommends 2 brand new stocks to its members each month, sent directly to their inbox. Their average stock pick has returned over 500% as of when I'm recording this. That's beating the market by almost 5 times. To get that report for free and to check out the Motley Fool's top stock picking service, visit fool.com/Arvabelle or click that link in the description. Then you'll hopefully be on your way to living smarter, happier, and richer. So if you decide to invest in stocks or ETFs, what are the easiest account types to start with? If you have a full-time job, the easiest place to start may be with your employer. So if your company offers a 401k, they usually make this really easy to start investing in. This is an investment account type where employers will sometimes match the money that you put into it up to a certain amount. So for any money that you put into it, that is being deducted from your paycheck and being put into that 401k. But the upside is that if your employer is matching it, then you're really kind of getting some free money from your employer that's being invested for you. You'll usually have to talk to your HR department to figure out the specifics for your company, but they do generally make this really easy. A lot of times they will have a particular brokerage or a particular app that they have their employees use, and they may have some different funds that you can pick from, or they may let you do your own thing. Again, it totally just depends on your individual company. If you're self-employed or if your employer does not offer a 401k, another good option to look into is a Roth IRA. What makes this type of retirement account unique is that the money that goes into it is after tax money. So once you get paid, those taxes have already been accounted for, already been taken out of your paycheck. You can put that money into a Roth IRA. Once you actually hit retirement age, you can withdraw the money that you put in there and any gains that you made, and you can do that tax-free because those taxes have already been paid on the front end. Another great option for beginners is to look into robo-advisors or into investing platforms that have pre-built portfolios. These platforms and apps automate a lot of your investing for you. Sometimes they have different funds that you can choose from. Sometimes they do have those pre-built portfolios, and sometimes you'll go through this questionnaire and they'll build a portfolio for you based on your risk tolerance and based on what you say you're actually interested in investing in. These platforms are a great place for beginners to start, but what you do want to watch out for on these are the fees. So you want to go for the lowest fees possible, or even better, no fees, because you don't want those management fees or like the membership fees to actually eat into the profits that you're making from investing. Outside of stocks and ETFs, there are a few investing options for those of you that are interested in real estate but don't have enough money saved up to make a down payment on your own property. Now there are several popular real estate crowdfunding platforms, and basically those allow you to put in smaller amounts of money into these real estate projects that are going on, and that allows you to have a little bit of that benefit from those properties without actually having to own them, operate them, or renovate them yourself. These platforms work by pooling a bunch of investors' money together to be able to get these different commercial properties or single family homes. And so from any of these projects, you may earn a dividend distribution from them, or you may earn some money from the appreciation of the property. It just depends on what platform you use and what properties you're actually investing in. Alternatively, you can invest in real estate through REITs, or real estate investment trusts. These are kind of a similar concept, but you can buy these on a stock exchange. So they have a ticker symbol, which is that series of letters that represents it on the stock market. So for example, VNQ is Vanguard's real estate ETF, and it's the largest US REIT ETF. So REITs are companies that usually own or finance real estate properties. Sometimes they are going after a particular sector, so they may just go after hospital buildings or healthcare buildings, or they may may be into commercial real estate or again, single family homes. And sometimes they cover multiple sectors. It again just depends on that particular REIT that you're looking at. And you can just Google list of REITs and you can find all of them that way. So basically what this comes down to is if you just have $1,000, start using that money towards building your skills and increasing your income. And if you do have that $1,000 with extra money coming in, start looking into your different options and what you think is going to fit best for you, whether that's ETFs, individual stocks, or looking into alternative things like REITs. And remember to check out that free special report that I put together with the Motley Fool on the 5 stocks that I'm watching now. You can find that report at fool.com/Arvabelle or using the link in the description. And I will see you guys in the next video.